Owning your home outright used to mean one thing in Australia: security. No mortgage, no landlord, no rent increases to worry about. But across the country right now, in a growing number of suburbs, that sense of security is quietly slipping for retirees. Rising council rates, insurance premiums jumping by thousands of dollars a year, exploding maintenance costs, and utility bills climbing faster than pension increases can keep up with. If you are a senior homeowner or you are helping a parent navigate retirement, the next few minutes could genuinely change how you think about your financial future. Welcome back to my channel, your trusted source for the latest updates affecting Australian seniors. Today we are talking about a dozen areas around the country where homeownership is becoming a real financial pressure point for retirees. This is not about creating panic, it is about awareness, because when you understand a risk early, you still have options. For decades, the Australian retirement dream followed a simple formula: pay off your mortgage before you stop working, let the age pension cover your day-to-day living costs, and your home would give you lasting peace of mind. In 2026, the cost of simply keeping that home is rising in ways many retirees never anticipated, and the old assumptions no longer hold as firmly as they used to. Let's start in New South Wales. In parts of Western Sydney, suburbs like Penrith and Blacktown have seen property values grow significantly over the past decade. Many retirees who bought in the 1980s or 90s now technically own homes worth far more than they ever imagined. On paper, that looks like wealth, but rising land valuations often bring rising council rates with them. Add higher building insurance premiums, especially in areas with flood exposure, and annual costs can climb sharply. What once felt like a rock-solid asset can start to feel like a growing, ongoing expense. The central coast of New South
Wales tells a similar story. For years, it was a popular, more affordable alternative to Sydney for retirees, but population growth and stronger housing demand have pushed up both prices and local government charges, and insurance premiums in storm and flood-prone pockets have climbed dramatically. For someone living solely on the age pension, even a few $100 extra each quarter can strain a fixed budget. Moving north into Queensland, suburbs in Logan and Ipswich have experienced strong growth as interstate migration boosted demand. Rising prices sound positive on the surface, but higher valuations tend to translate into higher rates, and insurance in flood-vulnerable Queensland zones has become significantly more expensive. Retirees who once saw these suburbs as affordable options are now facing annual housing expenses that outpace pension indexation, and that gap keeps widening. The Gold Coast is another clear example. Coastal living has always attracted retirees, but climate-related insurance adjustments are pushing premiums upward in certain postcodes. Combine that with rising utility costs and general inflation, and the gap between modest pension increases and real-world living expenses becomes impossible to ignore. Owning your home outright does not make these pressures disappear. The bills keep arriving whether or not there is still a mortgage attached to the property. In Victoria, outer Melbourne suburbs such as Werribee and Frankston have seen substantial growth in recent years. Retirees who bought decades ago have benefited from rising property values, but higher valuations often flow through into higher local rates. Maintenance costs on older properties are climbing too. Roofing, plumbing, electrical, and structural repairs now cost considerably more than a decade ago. What used to be manageable upkeep can quietly turn into a major financial event. Tasmania, particularly Hobart, has experienced unexpected housing growth of its own. What was
once considered one of Australia's most affordable capital cities has seen genuinely strong price increases. Seniors who relocated there specifically for lower costs are now facing higher living expenses and rising service charges, and the affordability advantage that drew so many people has narrowed considerably. In South Australia, the outer suburbs of Adelaide have also seen meaningful price appreciation. While still relatively affordable compared with Sydney or Melbourne, increases in rates and living costs are noticeable for retirees on fixed incomes, and every extra dollar spent on rates or insurance is a dollar no longer available for everyday needs. Western Australia presents its own particular challenges. Suburbs around Perth that tend to move with mining boom cycles are again seeing shifts in the property market. Rate adjustments, insurance recalculations, and a fluctuating local economy all create uncertainty for retirees trying to plan around predictable annual costs. Regional and coastal towns across the country round out this picture. Many seniors relocated to lifestyle towns in New South Wales and Queensland, expecting a relaxed, affordable retirement. Demand from remote workers and investors pushed prices upward, local councils adjusted their rates accordingly, and insurance companies reassessed their exposure to climate-related risk. What once felt secure and inexpensive suddenly started to feel expensive. So what is actually driving all of this? A few forces are working together. First, inflation has raised the baseline cost of maintaining a property. Materials cost more, labor costs more, and tradespeople are in high demand, so even a routine repair can deliver a real shock to the household budget. Second, climate risk pricing has shifted dramatically. Insurers are recalculating premiums based on flood maps, bushfire exposure, and storm frequency, and some homeowners are seeing double-digit premium increases year after year. Third, local
governments rely heavily on property-based revenue, so when valuations rise, rates tend to follow, and even when the percentage rate stays steady, a higher property value still means a higher total bill. Fourth, utility and service charges have been climbing steadily as well. Electricity, gas, water, and waste management costs are increasing across multiple states, and these ongoing expenses do not pause simply because someone has retired. There is also an important misconception worth clearing up here. Many retirees assume that once the mortgage is paid off, housing costs become minimal. Mortgage-free does not mean cost-free. The ongoing expenses of ownership, rates, insurance, maintenance, and utilities continue regardless of whether there is a loan repayment attached to the property. There is also the question of liquidity. Your home might be worth $1 million on paper, but that value does not help you pay a quarterly council rates bill unless you actually access that equity. Some retirees consider downsizing or government-supported equity release schemes, and each carries real consequences worth careful thought. Downsizing can reduce ongoing maintenance costs and free up capital, but selling and buying involves agent fees, stamp duty in most states, moving costs, and genuine emotional strain. And in competitive markets, finding an appropriately sized, affordable home nearby is not always simple. Equity access schemes let you borrow against your home, but that borrowing reduces the eventual value of your estate and has to be repaid at some point. So these are not decisions to make lightly or quickly. So what can you actually do if you live in one of these areas or somewhere with a similar pattern? Start by calculating your true annual housing cost, including rates, insurance, utilities, maintenance, and any body corporate fees where applicable. Many retirees genuinely underestimate this yearly total, and putting every figure down on paper often reveals a
Clearer and sometimes more concerning picture than expected. Next, compare that total against your annual income from the age pension and any other sources. If housing costs are consuming a large portion of your income, treat that as an early warning sign, since the sooner you notice that imbalance, the more time you have to respond thoughtfully rather than react under pressure. It is also worth reviewing your insurance policy carefully, checking for coverage gaps and comparing quotes where possible, since staying loyal to one insurer does not always mean the best price. Plan ahead for major repairs too. If your roof is 25 years old or your plumbing is aging, it is worth setting money aside gradually well before an emergency forces your hand. It is also worth exploring community support programs or concessions available to seniors in your state, since some local councils offer rate relief options for pensioners, and using these programs when you are eligible can genuinely ease the pressure. Most importantly, do not ignore the early warning signs. If you find yourself delaying repairs, cutting essential expenses, or feeling anxious about annual bills, take action sooner rather than later, since waiting rarely improves the underlying situation. It is also worth remembering that the family home remains exempt from the age pension assets test while you continue to live in it, and that provides genuinely important protection. But that exemption does not shield you from the rising out-of-pocket expenses of actually maintaining the property. These are two separate issues, and both deserve your attention. The housing market is not static. Economic conditions evolve, government policies adjust, and insurance industries continually recalibrate risk, which means retirement security in 2026 genuinely requires ongoing awareness and planning. If you live in Western Sydney, the Central Coast, Logan, Ipswich, the Gold Coast, Outer Melbourne, Hobart, Outer Adelaide,
the Perth growth corridors, or a rapidly growing regional town, now is a good time to take an honest look at your own position. This is not about assuming the worst. It is about recognizing that homeownership carries real, ongoing responsibilities. And the earlier you assess your financial resilience, the more control you keep. If you found this information valuable, share it with another senior who might need to hear it, and subscribe for more reliable updates on age pension changes, housing pressures, and financial strategies for Australian retirees. Stay alert, stay informed, and I will see you in